The Committee on Banking, Housing, and Urban Affairs will come to order. Thank you all for joining us, Senator Scott. Thank you for your work. All of our work on safeguards for our banking system must come back to one goal: protecting Americans' hard-earned money in the bank, protecting American taxpayers. Because working people have been forced to pay for big bankers' bad decisions over and over. In the wake of three of the nation's largest bank failures in history, three of the largest in history, this committee held a series of hearings with failed bank executives, the bank regulators, and outside experts. It's our job to hold accountable everyone responsible for the gross mismanagement and risk-taking behavior of these bank executives that threatened the stability of our banking system. Out of that effort, this committee came together. Senator Scott and I worked hand in hand on this to advance a bipartisan bill that will hold bank executives accountable for their misconduct to help prevent future bank failures while protect consumers and taxpayers. The Recoup Act, the bill we passed 21-2 out of this committee, will ensure that executives who follow the Wall Street profit at all costs business model will not be able to cash out when their bad decisions threaten middle and working class families' financial security. The Recoup Act is an important and necessary step to prevent bank failures. This committee will work to get it passed into law. The collapse of the Silicon Valley Bank, of Signature Bank, of First Republic Bank illustrates why we need important guardrails on executives, on the way big banks operate. We need better protections, stronger capital liability standards, for instance, tougher stress tests, and more rigorous enforcement and supervision. The bank failures also raise questions about our federal deposit insurance system. That's what our hearing's about today. SVB and Signature ignored liquidity risk. They used overwhelmingly uninsured deposits, all concentrated in the same industry, to finance unsustainable growth. More than 90% of deposits at SVB and Signature were uninsured, more than 90%. That's about twice the average at Ohio's regional banks and far more than that at community banks. And when those bets don't pay off, venture capitalists triggered a social media-fueled bank run, a panic that led to consumers yanking $42 billion out of SVB in less than a day. Signature Bank lost $18 billion. When these banks failed, small businesses whose accounts were at SVB and Signature Bank from Ohio to Utah and across the country just wanted to make payroll. Ohio banks and credit unions didn't want to see their deposits flee to Wall Street mega banks. Regulators, both Republicans and Democrats, came together to prevent the panic from spreading, protecting consumer and small business deposits without taxpayer money. The recent failures were not the first time we've covered the losses of uninsured depositors. We used the systemic risk exception and temporarily expanded deposit insurance in the past, including during emergencies like COVID and the financial crisis of 15 years ago. We understand the need to protect depositors, promote confidence and stability in the banking system in a time of crisis. But it's also our job to make sure banking safeguards work for everyone, for consumers, for small businesses, for banks that serve their local communities, not Wall Street mega banks and big investors. Deposits serve a critical function in our basic banking system. They are the source of our money supply, the financing that banks use to make loans to middle and working class Americans looking to buy a home or start a business. Community banks play a pivotal role in making these loans. They maintain close ties with their communities. They have a vested interest in the customers whom they see and whom they serve every day. People know these bankers and trust them to use their deposits to invest in their local communities and make loans to their neighbors. Yet decades of consolidation and concentration have led to deposit flights to the Wall Street mega banks, stripping wealth from local economies. And over the past 20 years, the number of commercial banks has been cut in half. Today, only 14% of deposits are held by community banks. If customers move their deposits to mega banks because they think they're the only place the deposits are safe, has an outsized impact on investment in local communities, the local economies and communities, especially in rural communities where often community banks are the only commercial bank presence. And when regulators take action to protect uninsured depositors and prevent a crisis from spiraling out of control, those costs, like the special assessment to pay for the failures of SVB and Signature, should be borne by the banks that take on the most risk, yet somehow still benefit the most. We can't let Wall Street mega banks siphon deposits from smaller banks, then scoop up failed bank assets at a discount, then continue to grow unchecked. When we, 90 years ago, created deposit insurance, we promised Americans that reckless gambling on Wall Street wouldn't put Americans' hard-earned dollars at risk. Since then, every time a bank has failed, FDIC's made sure that uninsured depositors didn't lose a penny, and working American families have the confidence to keep their money in banks without fear of a bank run. The purpose of today's hearing is to understand whether our current FDIC framework continues to fulfill that promise. Our panelists come from diverse backgrounds. I thank the three of them for joining us and present unique perspectives on what changes, if any, should be made. We need to make sure deposit insurance protects small savers, workers, and businesses, and promotes competition, confidence, and stability in the banking system, in community banks and credit unions and regional banks, not just the big investors and the big mega banks. We also need to make sure that the rules banks have to follow to prevent bank failures are strong enough too. Because make no mistake, increasing deposit insurance coverage without putting in place stronger guardrails is akin to throwing a lit match onto a pile of dried leaves. Changing deposit insurance is not a cure-all, to be sure. It's a complement to stronger financial regulations and banking supervision, sending a signal that the financial industry can make risky bets with abandon, and if their banks fail, the government will always pick up the tab, will only lead to more failures, more financial crises. We've seen what happens when big banks don't properly manage risk and build up sufficient capital. Too often, it's always workers who face the consequence. Every time Wall Street crashes our economy, we put tougher guardrails in place, protect workers and consumers and preventing from happening again, as we should. But then lobbyists go to work, watering down, sometimes erasing altogether important financial safeguards. We can't make changes without first undoing the rollbacks of financial safeguards that have reduced bank supervisors' ability to police unsafe practices and to ensure the biggest banks have sufficient capital and liquidity. Our financial watchdogs must work to strengthen our system, help our economy grow, support local communities, ensure working families and small businesses' money is safe. Senator Scott.